Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is the author of The Wealthy Barber, probably the most important personal finance book ever written in this country, David Chilton. Today we're talking about mistakes made by investors and by advisors. We see the markets over the long term, even after last year, delivering some very solid returns, 8-9%, including dividends. You know, a lot of equity funds and ETFs are delivering pretty good long-term returns, and yet I hear from investors continually, I've done very poorly. I'm underwater for 10 years or 5 years. Why are investors underperforming the products and indexes?
Well, a couple things. You're not getting a scientific view either, because the people most likely to call you to complain are the ones underperforming. You'll get very few calls from people saying, yeah, I'm posting those numbers. That being said, you're right. We don't keep up to the averages. Costs are a big part of the problem, by the way, and we've all said this for 20 years, but Canadian expense ratios on mutual funds, and that's the primary vehicle people use to gain access to the markets, they're too high. I don't know how any rational person can argue that. Anybody with this much on the mathematical skill front cannot argue that Canadian expense ratios.
Okay, let me ask you a question. Why are they so high then?
We don't have a public that's demanded they come down. The setup of our industry doesn't have enough competition from fee-only financial planners. ETFs are just making inroads.
You're an influential man. Give a plea to the investors watching this to ask and demand lower costs.
Well, they have to. I mean, it's absolutely nutty. And you know what it is? People don't understand the concept of percentages on percentages. That baffles people. If you're hoping to make 8% a year and the mutual fund's taking 3%, they're taking 37.5% of your expected return. Well, I don't care if the markets are inefficient at times. That has to be one smart mutual fund manager to overcome that kind of performance drag. And most can't, by the way.
Most mutual fund managers cannot beat their benchmark index.
Well, all the stats prove that. I mean, they really do. I mean, it's very difficult. And again, we're getting a false view of those stats too because of survivorship bias. A lot of times people look at the currently existing funds and they'll go back 20 years and say, actually, 47% did outperform their benchmark. Yeah, but we had all kinds of funds leave the marketplace because they were dogs. So you've got to be very careful of all that. So mistake number one is we don't pay enough attention to costs. But the biggest mistake, even bigger than costs, interestingly, is our emotions still sabotage our investment process constantly. The more we learn about behavioral finance, about the way the brain works, the more we realize we're ill-suited. We're improperly wired to invest well. We suck at investing, Rob. I normally don't use that kind of language in an interview environment, but there's no real other way to capture it. We are horrible. I mentioned in a previous interview, nobody sees more financial plans and investment plans than I do. I get them mailed to me from all over the country daily. It's amazing how poorly people invest their money.
Okay, one last question. If you could give people one piece of advice on how to curb their emotions in their investing, what would it be?
You have to have a true plan. I know, again, this sounds corny, whether it's buying monthly, whether it's buying annually and rebalancing on a twice-a-year basis or once-a-year basis, and you have to stick to that plan over extended time frames. It's only through doing that that you take emotions out of play. Emotions are your biggest enemy. We get very fearful, obviously, during very difficult times. We therefore get out of the market instead of in. These are all things we've talked about many times in the past, but they're true. And we're just seeing it again right now as we go through this current very challenging market climate. People got out, of course, so many people last year, and for good reason. That was pretty stressful. Yep. And now as the markets have roared up 50% from their lows, now people are starting to think, maybe I should get back in. This is why when you see an investor's performance in a mutual fund, it's almost always under the performance of the mutual fund itself.
Thanks, Dave.
Thank you.